Family radio for a really great future. We're talking real money.
You know, they say that if you have a dog in an ad, that it just makes the ad so much more appealing to people that they look at that and they go, oh, that's a wonderful product because they have a dog. Does it count when a radio show has a host with a dog on his foot? Does that count?
Are you referring to me as a hound of some kind?
Hound? Or? No, the puppy.
Your dog.
Debbie left with the big dog. And so the little dog, she's young. She's not even 6 months old, and she does not like to be alone. So I brought her up to the studio, and she's laying on my foot under the desk in the studio. And so I just wanted to warm everyone's heart with a
I think what
story.
They say is not to have dogs or children on the show or in a movie because they upstage you. I believe that's what they say.
Well, and I could stand some upstaging.
You're way upstage, friend.
And speaking of dogs, do you know that this is going to be a great segue. You're going to love this one, Tom. By the way, Don McDonald here, Tom Cock over there, talking real money, 855-935-TALK, 855-935-8255. You're going to love this segue. There is what used to be a very, very popular investing strategy, speaking of dogs, called the Dogs of the Dow.
Yeah, right.
And speaking
I'm aware of it.
The Dow part of the Dogs of the Dow.
Okay, wait, you got to finish what the strategy is first.
Oh, the Dogs of the Dow, that's buying the worst performing stocks in the Dow Jones 30 Industrial Average. The thing that most people in the media and most of us as individuals call the market. That could not be further from the truth. And that's the point we want to get to. I even had a website that I put up saying, stop calling it the darn Dow. The market is not the Dow. And there was another great example of how horrible an indicator of market activity the Dow Jones 30 Industrial Average actually is by our good friend Jason Zweig of the Wall Street Journal. Tommy.
Well, he makes a great point. Okay, first of all, I think anyone listening should try to decide what company is more important, a company that is worth trillions of dollars in market capitalization, the value of investors put it on, or a company that's worth a few $100 billion.
Oh, a mere few $100 billion,
right. I mean, I know that sounds ridiculous, but that's really what this argument is discussing here, because with the Dow Jones Industrial Average, they rely on the price of the stock to determine which are the most important companies that have the biggest impact on the index. I'll give you an example. United Health Group. Oh, I'm sure you're very familiar with those folks. That's the biggest stock in the Dow, constituting now 9% of the index, 1/10 of the index.
Wait, Tom, is United Health more valuable than Apple or Microsoft or Alphabet?
By far.
Is it more valuable than them, or does it just...
No, not even close. According to this index, yes. But if you go, for example, by the market capitalization, the value of the company that investors have put on it, Apple should be about 25% of the index, which is still ridiculous, by the way. Mm-hmm. Microsoft would be at about 23% of the index. You get the idea here. This is a very silly way to determine which stocks are most important, because you could just simply do a reverse
stock split. A reverse, for example,
split,
let's say I want to dominate the Dow, and I'm one of the 30 stocks in the Dow. I just reverse split my stock, so instead of it being worth $100, like I do a 1 to 20 reverse split, I turn 1 to 20. Yeah.
You got me going there.
20 to 1. And I turn 20 shares into one big hunkin' $2,000 share.
And now
I'm a bigger part of the Dow. I'm the biggest part of the Dow.
You're the biggest. Yeah, you're the biggest. It's so outdated, and that goes back to
1880s.
Like 100 years ago.
Almost 150 years. When Charlie Dow, this was before they even had real adding machines. He had to do this stuff on paper. So Charlie Dow was going, how do we help people understand what the market's worth? And he goes, I'm going to take the 30 highest price stocks, the 30 big ones. We're going to pick them out.
Divide it by 30.
And we're going to divide that by 30 because I can do that math in my head.
Easy. Yeah, easy. So what the point of the matter is, this year is another demonstration about how completely unnecessary it is. The Dow is up 1.2. The S&P is up 9% year to date. Yeah, that's really, neither should be followed exclusively. We'll talk more about that in a minute.
Yeah, it is not indicative of the real market. 855-935-TALK. Call us.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Hi, everybody. I'm Don McDonald. That guy over there is Tom Cock in the Seattle area. I'm in Florida, where it's hot. But in my studio, it's lovely. Tom's in Seattle, where it's not supposed to be hot. In his studio, it's steamy.
Yeah, I know. It's weird.
What is
it's
wrong
not
with
that
this
hot
picture?
outside. It's like 75. It's 73. So
That's it?
The big windows, man. The big windows. Yeah.
Solar heating.
Exactly.
Yeah,
Feeling better.
Sometimes it's good.
I'm not going to complain.
Not so good.
Not going to complain.
We're talking about the market. What is the market? Is the Dow the market? Is the S&P 500 the market, Tom?
Nope.
What is the... Oh, by the way, our phone number is 855-935-TALK if you have a question about the market or anything else. What is how do we define the market? It's so hard.
It is, and it's hard to just, because the media outlets do not have a number that they give you. I think for a while you encouraged them to do the Vanguard Total World.
Or I think it was the Dow. It was the Dow.
The Dow Total World.
Dow Total World.
Because I think there is an index, and even that doesn't. Here's what the market is. The market is 10,000 plus stocks around the world, because truly that is a better measure of what's going on in stock markets. When you just say the S&P 500, that's just 500 of the largest U.S. companies. When you say the Dow Jones Industrial Average, if you really know anything, as we just mentioned, that is a very silly measure of really almost anything other than 30 kind of aging, well, I guess Apple's not that old, but kind of old U.S. companies. It's really awful. And by the way, a year ago, I think the worst performing Dow Jones stock was aerospace concern that has a large following here in the Seattle area called Boeing. And now for the last year, I think I just looked last weekend, it's been the best performing for the last year.
That's why you can never tell. But here's the thing. I just looked up the Dow Jones Global Index, and for those of you who'd like to follow along, its symbol is W1 Dow, if you want to follow it online. The Dow Global Index, year to date, has gained 7.65%.
Which is astounding, because I just looked at portfolio would be similar to what we manage. We're up a little over 2%.
But the reason, there's a good reason for that.
Yeah, there is a good reason. Yeah. I mean, that index, I'm betting, is more heavily influenced by large companies, growth companies. Remember, we're going to say you're going to overcompensate, put more into the small, more into value, by the way. And I just looked U.S. small cap value down 3.3% year to date. So that's been a drag. Mm-hmm. Whereas all the internationals are doing what? International large value up 8.5%, international small company up 7.5%, international small value up 8.3%, emerging markets up almost 4%, emerging markets value up 5.3%. So the international markets have been doing well. But again, the market has been dominated by large companies. What we want you to take out of all this is you really still want to be globally invested. You really don't want to rely on what the media proposes as indexes. And frankly, short-term performance is completely meaningless anyway.
A year-to-date performance is a meaningless number. A one-year number is a meaningless number. 5 years, it means very little. 10 years, it has some meaning. 15, we're starting to get into the area where the data is valuable.
Yeah, I agree. And the academics are still going to tell you anything less than 10 is completely worthless, where you are going to say, wait, the industry always says, what's your 1, 3, and 5 year performance look like?
Well, the perfect example of why 10 years is worthless is the United States in the 2000s, when the the benchmark of the U.S. market, the Standard & Poor's 500, not the Dow, but the benchmark at the time, lost an average of 1% per year for an entire 10-year period. Did that mean that the U.S. market was done? You should never be in it? No.
That's so long ago, we don't even care, Don. That was so long ago.
Right. Well, because we forget everything. And a little addition to that. Had you diversified 50% U.S., 50% international approximately over that same period, just globally diversified, you didn't try to pick much, you didn't pick anything, you would have made an average of 7% per year almost.
Which is just, people still, you'd give them that number and they are just shocked, flabbergasted, bemused. They don't believe you.
The U.S. was horrible for a full 10 years.
Yeah, well.
10 years.
Globally diversified, do it. You were going to give a couple other examples because Avantis has a global fund.
Yeah.
That is
Avantis, which is AVGE.
more leaning to small. Yep.
Yeah, AVGE, which is, it leans to small and it leans to value. So you've got you've got things dragging on the portfolio this year, just this year, and its year to date is about 4%. Whereas Vanguard's Total World, which leans larger companies, which leans more growthy, less value, that fund did over 9.5%.
Wow, which is
year
astounding,
to
frankly.
Year to date.
Yeah. Some really smart people at Vanguard. They really know how to pick those stocks, Don.
Yeah. They pick them the old-fashioned way.
Come on.
They pick them all. Yeah, it's just like all the stocks get a participation award. Nobody won. Well, they all get a participation award.
Like my grandkids' game or something? Or what the heck? Okay.
Congratulations to all of you. You're all winners. You're all coming in the portfolio. Welcome to Vanguard Total World. We are the most inclusive index in the world.
So the takeaways, I think, should be, number one, you still, chasing any of this is silly. Your portfolio should be, as we talk about, a risk-appropriate portfolio. Number two, we should bury the Dow Jones Industrial Average somewhere. I don't know. There's got to be a desert somewhere that needs a hole in it.
Why won't people stop quoting it?
I don't know. Make it go. It's because it's easy and it's there every day. And Dow Jones owns it. Shocker there.
Yeah, but it's S&P Dow. Isn't it S&P Dow Jones now? Aren't they the same or something? I don't know.
And then the third takeaway should be, and you just made another great point for it because of the quote-unquote lost decade, you want to do something? Go global. Right?
Go global. Go global. Go global. Be boring. Diversify. You know, I was never a cheerleader.
How's the dog liking that one, by the way?
The dog is still asleep on my foot.
That's a loving dog.
That dog is asleep on my foot. This dog is such a great dog. I don't know how we lucked out. This dog was house-trained by 10.5 weeks. Totally and utterly house-trained.
You spent more on that dog than I did my first house, I think.
No.
I
think Debbie paid $1,500. Yeah, it was like $1,500 for this puppy.
Oh, that's about what I probably paid
for the first
house. I think so.
But man, she's
see why I'm in
amazing.
my second marriage now.
Debbie's thinking about starting an Instagram page because she's so popular on Facebook. Debbie Facebooks her. So 855.
That's passe. Yeah, you got to get Instagram or something.
Instagram,
TikTok or something like that.
I can't keep up. So guess what I do? None of the above.
Nothing.
Yeah,
exactly.
Well, Vanguard is inclusionary. I'm exclusionary when it comes to social media.
The Chinese don't know as much about you then.
Wacky,
you're okay.
Wacky. 855-935-TALK. That is a really important phone number because it brings you here to have a conversation with us. Now, we take a lot of calls from you guys. We take them.
A lot of questions.
Yeah, a lot of questions that we get from TalkingRealMoney.com or called into 855-935-TALK other hours. But those get recorded and we can't have a conversation. Only 2 hours a week are devoted to real conversation. So we would encourage you to call on a Saturday between noon and 2 Pacific, 3 to 5 Eastern, 855-935-TALK.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
In addition to calling us on our toll-free, which is sort of a silly thing to say, phone number. Yeah. It's funny. I called England the other day about a product.
How is he?
Because I was trying to return a product. You know how they say they have a guarantee and you can return it for any reason. And so I sent them 2 emails and went on their website, and they haven't responded to any of them. So I looked up their number in Great Britain and
called them.
I called, and the number's been disconnected. But
so
I did not get charged for the call. It was free.
That's good. Speaking of England and numbers, I know on this program we talked about the fact that the coronation of the new King of England cost $100 million. I'm not supposed to bring this up.
You're not. We got a lot of grief over this.
I know, but here's the reason. Because guess how much the funeral of his mother cost? Now take a guess. It was in the paper. $200 million. Sorry, that just sounds funny that you spent $100 million on the guy who's alive. Anyway, I'm okay. That didn't come out right, I guess.
No, it did. It did. I get it. Well, and really, when you think about it, okay, never mind. I am.
How much
never
do you want on yours? I'm going to set some aside now.
You know,
how much?
Do you have a post hole digger? Just
yes, I do.
Dig a hole in the backyard.
I have a swamp. You'll last about a week out there before the little animals find you, and that'll be that. So
I'm thinking. My first idea was coat me in like plastic, and then bury me somewhere in the mountains so that some archaeologist someday can go, there were plastic people back in the past.
Look at that, the Colorado Rockies. It's crazy.
But I'm not going to do that. Just
let's go to question. What do you say? Give him the number.
Oh, by the way, the number is 855-935-TALK. Tom doesn't know the number.
Good.
855-935-8255. But remember, you can also send us questions at talkingrealmoney.com. You can type them in like this.
Yeah, Allison writes us from Wright City, Missouri, which apparently is you don't go left because you go to wrong city.
That was coming. Okay, I felt that one from...
Yeah, I
think I felt that from before you started reading.
I go a long way for that joke. My husband and I have our Roth IRA set up through Edward Jones and max it out every year. Well done. Right now, our advisor has us invested in American funds, and she goes through a bunch of the tickers, which I'm not going to do. After researching, we realized all of these have front-end loads. That's a commission.
Yes, that is correct.
12B1 fees. That's a commission. I don't care what they say.
It is.
And high expense ratios. Expense ratio refers to how much the fund takes out to pay themselves, the accountants, the advisors, etc. Our report says our cost paid to Edward Jones last year was 0.70. That seems like we're paying out more than fees than we realize. Any reason we should stick with our advisor? Are these funds somehow better than we think they are? We're thinking about jumping ship and switching our Roth IRA to Vanguard, but we want to make sure we're doing the right thing. This is going to take a long time, I know.
Yeah.
So you go ahead.
Well, you live in, she's in Wright City?
Missouri.
Yeah.
Yep.
Well, you've been in wrong city, and you're really you are truly now heading for Wright City if you make the change. I think that would be the right decision. The previous decision was the wrong decision, but you didn't know it was the wrong decision because the people who make these sales, well, my friends, they're all so nice. They're so nice, and they're a pillar of the community.
It's hard to separate, the niceness from the
reality is, let me give you an example. Let me take a very middle-of-the-roadish kind of fund. You say, are they better? Well, one, this middle-of-the-roadish fund, American Fund's Balanced Fund, middle of the road, 60-40, expense ratio is 0.57. Okay?
Yep.
The average annual return, hold on, let me go. The return year to date right now is, because we talked about that earlier, is 3.7, where the balanced fund index has returned 6.27 year to date. So are they better? Well, they haven't been in the short term. In the longer term, they have been only fractionally better, but they're actually fractionally better with more risk. That's why they're fractionally better, because they have a smaller, less diversified portfolio that is going to show a higher degree of volatility. So, yeah, risk reward is good, but not a great fund.
Tom and Don are talking real money. future. We're talking real money.
Puppy update. The puppy is still asleep at my feet. Apparently, the sound of talking real money is either soothing her or boring her to tears. One or the other.
I'll go with the latter on that one.
You're probably right. 855-935-TALK. You want to talk money? We want to talk money with you because that's what we do. It's our passion. This is our passion project for Tom and me. 855-935-8255. And now is the time to talk with Frank. Hello, Frank. Welcome to the show.
Hi, I'm glad to be here. Thank you for taking my call. First-time caller and recent listener. I have a question. I'm calling from sunny Southern California. I'm a teacher, and I retire, having some pension plus a couple of things, a 403B and a 457B. So I'm trying to figure out what the fees are for those. 403B compare I have, but there seems to be nothing for 457Bs. Any guidance, advice would be greatly appreciated for those. Thank you.
Yeah, I mean, here's the thing. Pulling apart those plans to figure out what you're paying, God bless whoever does that, because we've tried. We're in the business, and we tried to pull one apart that was custodianed at Merrill Lynch, and we spent like 10 hours a week, couldn't figure it out. So, I mean, okay, but there's some easy things you can do, Frank. Number one, you can tell the cost of the funds that the underlying assets are in. So there's a starting place. So
and those tend to be the highest.
Can you give us one mutual fund from either the 403B or 457 that you can recall?
Sure. A total Vanguard, total market index. Vanguard.
Well, that's good. That's cheap. Gee. That's what we're looking for. You almost never hear that in the 403Bs or 457. So that's very low expense. What about if you needed to buy some small cap stock exposure? Any idea which fund you'd be in there?
Probably another Vanguard one. I haven't looked at those. Okay. I've gone total.
If you got Vanguard products, that's good.
If your your trustees, your custodians are smart enough, savvy enough, honest enough to go for these incredibly low-cost Vanguard index products, then my guess is, and it's a good guess because we've seen other plans. My guess is that their custodial fees and administrative fees are incredibly low.
Yeah. So, and you're probably in good shape. So, but here's the thing: a couple of just quick items because we see this happen time and time again. Do not get convinced by someone who reps the firm that might be in charge of those plans to buying an annuity, because we see a lot of educators that end up taking money out of those plans and putting it into an annuity. Please do not do that. Number two, you need a plan around which place to draw from, right? The 403B, the 457, when to start the pension. Do that prior to retirement.
Do what again? Start planning beforehand.
Start planning for withdrawal. Yeah, from where you're going to. You need everybody who's going to, and you're doing this for retirement. You need an income plan to figure out from where your cost of living will be derived, from which products and how.
Okay, and it could be a mix, obviously, depending on my situation.
Yeah, absolutely, sure,
100%.
Bet. Yeah.
Okay.
So, sounds like you're in pretty good shape, Frank. It really, truly does. I think that you have an honorable employer, which is unusual in the nonprofit arena, who's giving you some really...
Well, they're honorable, but they just get taken in by bad actors.
Right. It's not the companies that they're just not acting as true fiduciaries. They're letting somebody they know guide them into bad decisions. And it is really I just think your employer, it sounds like there's someone who's really stepped up to the plate and done their work, and I commend companies like that.
Because we see so many bad plans in 403Bs and 457, so it doesn't sound like yours is one of them. Yep. Thank you for the call. And by the way, we will be talking, albeit briefly, about withdrawals at our class next Wednesday, which we haven't spent much time talking about. You can no longer come to our office in Bellevue to do that because that's sold out. But It's going to be like 45 minutes to an hour long. It's all virtual, and you can register at talkingrealmoney.com. It's going to be a great class. We don't do a lot of these anymore, so come see us.
We do 2 classes a year and retire meet, and that's the extent of it. That's all we do.
So join us Wednesday, 9 a.m. Pacific time. For those of you playing along from the left coast.
We're on the show, so we're on the radio today. So I'll give you Pacific.
So I'm okay then?
I'll give you Pacific.
Oh, thank you. Thank you for that.
I mean, everybody listening today is in the Pacific time zone, pretty much, except for those listening online.
No, he's in Southern California.
I know, except for a few listening online. 855-935-TALK. That's the number. Please give us a call.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Hi there. Welcome back to the show. I'm Don. That's Tom laughing into the break again because he does that. I find when I have to edit the show to turn it into a podcast, I'm having to take the track with Tom on it, and I'm always having to cut out the laughter over the theme song. Because it's like, you hear me? 855-935-TALK is our phone number. Give us a call.
Not going to do it this time.
Not going to do it. Look, he's not doing it.
My passive-aggressive response.
He's holding it in. Oh, look at him. He's seething. Scott, you're up next. Welcome to Talking Real Money.
Hey, Tom and Don. How you guys doing today?
Good, sir. Good, sir. Thanks.
Good deal. Yeah, I appreciate all the free content y'all put out there. Recent listener, but I was able to go back and listen to all the podcasts and past shows, so really good stuff out there. Appreciate all y'all do. My question today is around whole life or permanent whole life insurance plans. And I've been able to dissect kind of y'all's past podcast that how y'all feel about annuities. It's pretty clear stance. Don't like them. I understand that. I'm not as clear as y'all's stance on whole life. It does seem like y'all don't like them, but my thought process is for something of a similar return scheme, like around the 4 to 6%. It just seems it has some added benefits that I haven't found in other investment vehicles, specifically around having your money work in 2 places at once, by being able to take a loan out for almost all of the cash value there, and then be able to use the loan to invest elsewhere in that. So I just wanted to see what y'all's thoughts were on that, and if I'm not thinking of it correctly.
Who in the heck is paying 4 to 6% on a cash value life policy? 4 maybe, but 6?
Not 6. Yeah.
Not with their costs of doing business. Their costs are incredibly high. We don't. Okay, let's talk about why you need life insurance. You see, this is you got to one. Don't trust the people. Don't trust without verifying what the people who are selling a product are telling you, because they'll tell you a lot of things. The insurance industry is notorious for telling you things that aren't totally true. They're partially true. Partially. For example, why do you need life insurance? What is the need? What do you need it for?
Yeah, so my thought there is that I can draw down on my other investment accounts once I get into retirement.
It's not what we asked. We're going to stop you there, Scott.
Scott, hang on.
Okay.
Let me rephrase the question. What is life insurance designed to do? What was its original purpose? The purpose of, there's a clue in there, life insurance.
Yeah, I think it's to supplement or replace your life, would be life income, right?
For if you died and somebody was dependent upon you. Question 1, is somebody dependent on you for income?
No.
1 strike against it.
Answer should be pretty apparent. There'd be no reason. I mean, I have life insurance because I have a wife and a 15-year-old at home.
Mm-hmm, but it's not. It's not whole life.
No, it's not whole life.
It's not whole life.
And I was going to get into why I don't like that. But
go ahead. Go ahead. No.
Well, I don't. I rent it.
Yeah, you rent it.
Rent the life insurance. That's it. I have it, and then when I don't need it anymore, then the rental's over.
Because you have to bear in mind that a portion of the money you put into this is the thing they don't tell you about. A portion of the money you put into a cash value life insurance is actually paying for the life insurance. Then there's the extra money that goes into the cash accumulation account.
Extra funny. Yeah.
Yeah, because the premiums are higher. Whereas you could invest that money on your own, and I am incredibly confident that you could make more than the insurance will pay you, because the insurance is going to pay you less than they can make on the money. And you're not going to make 4 to 6% on all the money you put in. Remember, some of that is going to go to pay for life insurance. It'll only be on a part of it. And this borrowing against the policy is humbug. It is ridiculous. It is so silly. You borrow against the policy. You don't pay yourself any money. Your money doesn't make any money. But let me tell you a little problem. If you don't continue to make your payments on the insurance
premium,
that loan becomes immediately taxable. They don't tell you that part.
You know, I mean, it's one other thing for anybody to think. When you go through all that, Don, here's how it feels. Complicated. Yep. I've got insurance for cars and homes and umbrella and all the rest of it. Not the umbrella, but umbrella policy. I got that. I have
when you live in Seattle, you have to cover your umbrella because it is so important.
Thank you.
So he's got umbrella insurance.
Yeah. But then I have my investments. I've got like a 401k, a Roth IRA, a brokerage. I got that stuff too because that's hopefully going to grow and pay me and us in retirement. Never the twain shall meet in my life. And it just feels like when you do it, it just gets complicated and hard to figure out and this, that, and everything. I don't know why there's no free money. They're not doing you a favor of some kind by doing this because they're not in the business of doing favors. They're in the business of making money.
And Scott, the funny thing about funny thing about whole life is that I guarantee somebody talked to you about it, right?
Yeah, I've talked to several companies, and there's obviously some that I wouldn't even touch, with a 10-foot pole like Northwestern, and then there's some that I found were a little, better. At least they came off better, but yeah.
Yeah, because it came off better. But there's an old adage about annuities, and this applies to cash value life. These products are not bought. They are sold. I cannot think of a single person that walked into I've never heard anyone call in the 30-plus years I've been doing talk about money. Never had a person call and go, I walked into my local insurance agent's office, and I told him I must have whole life. I don't care what he says. Term, he told me to get term because he was really honest, and I told him I must have whole life. Never, ever heard that, but I've heard a lot of people call and go, boy, I wish I hadn't bought that whole life that guy told
annuity.
Me to buy. Or annuity. Yeah, they're interchangeable. They're interchangeable because you have to remember, in order for them to pay you X, they have to make X plus plus plus. And you personally can make X plus 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 if you take out the middle people.
Gotcha. Yeah, makes sense.
Okay, Scott?
I appreciate that. Appreciate y'all's clarity on that. Thank y'all.
Thank you. Appreciate that.
Thank you for listening to all the... Did he say listen to all the back podcasts?
You listen to a lot of them, which is awesome. Amazing.
It is awesome.
No, there's only 1,200.
Oh, pardon me.
There's like 300 that vanish somewhere in the ether when we switch services. We lost
around the moon or something.
We lost like 300 of our old shows from back in 2012 or something. I don't know.
Okay.
Anyway, and the other interesting thing about this is that if you talk to any smart financial advice providers who aren't selling products like us on the radio, don't you think with the experience that we have decades of experience in this industry, between 100 years almost, we're just old. Don't you think if cash value was a really good deal, we would be buying it? We'd be all over it. Yeah, we'd be all over it if it looked like it was a really good deal. But we've done this, and the costs are high. They've got to recover all those. There's really a logic to investing, Tom. It's simple.
But people don't want to believe it. They hear this and they think, aha, I have found the thing where I can make all this money and take no risk, and I can get life insurance. No, simplicity better, low cost.
Joe from church told me so. 855-935-TALK.
Drag religion into this? Come on.
855. Okay, Joe from the Kiwanis Club. 855-935-8255. Give us a call.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And we want you to join us next week for our big class next Wednesday, 9 a.m. Stay calm and retire strong. Tom and Don together.
Again.
Virtually any. I know that sounds kind of lame. You could, but it's 9 a.m. We're going to talk about. We're going to talk a little bit about investing. Talk a little bit about retirement. Kind of make sure that you're on the right track and not worried about things like the debt ceiling. The dreaded debt ceiling.
And all that other stuff you're worrying about.
Okay. You can register at talkingrealmoney.com.
It's easy. There's a button there. Just click on that. And by the way, Tom, I was good choosing the Kiwanis over the Rotary Club because the Kiwanis Club only has 260,000 members, while Rotary has like 1.4 million. So I was better to pick Kiwanis.
Feel so much better now.
Yeah, I get in less trouble. Thank you all. Talking Real Money.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. To keep the lawyers happy.